Have you ever felt like the economy is sending you some seriously mixed signals? You hear about growth on the news, but at the same time, you really feel the squeeze of high costs. Well, in this explainer, we're going to connect the dots. We're going to show you how a series of economic dominoes are falling, starting right here in the US and triggering a historic global gold rush.
Okay, so here's our roadmap. We're going to start with the weird contradictions in the US economy. Then we'll look at how America's debt is really the first big domino. From there, we'll follow the chain reaction to a global tariff shockwave, a major geopolitical realignment, a massive flight to gold, and then finally, we'll uncover the one systemic risk that might just be pushing all the others over.
All right. First up, let's try to make sense of the confusing signals the U.S. economy is sending out right now.
Yeah, this is the big puzzle we need to solve, right? On one hand, you see some headlines that look pretty good, but on the other, there's this deep anxiety a lot of people are feeling. The official numbers just don't seem to match the reality that many of us are living every day.
And this right here is where you can really see that economic tug-of-war in action. Yeah, we saw a solid GDP rebound of 3.3%, which sounds great, but look at the catch. Job growth has slowed to a crawl. I mean, only 22,000 jobs added in August. That's tiny. Unemployment is creeping up to a 4-year high, inflation is still stubbornly stuck above the Fed's target, and maybe most telling, consumer confidence has absolutely cratered to 58.6, which is way below its historical average.
So what's causing all this? Well, we're kind of stuck in what you could call a policy trap. You've got fiscal policies like tax cuts and tariffs trying to goose the economy, but they also pour fuel on the inflation fire. That forces the Federal Reserve to slam on the brakes by keeping interest rates high, which in turn slows down the economy. It's like having one foot on the gas and the other on the brake at the same time.
And that whole policy trap is built on an even bigger problem. And this is the first domino we need to talk about: the national debt. And look, this isn't some far-off issue for our grandkids anymore. It's here, and it's having a direct impact on all of us right now.
Just look at that number. The U.S. national debt has blown past a staggering $36 trillion. Now, to put that in perspective, our debt as a percentage of our entire economy is now higher than it was at its peak right after World War II. The big difference is, back then, it started going down. Today, it just keeps climbing.
But this is so much more than just an abstract number for politicians to argue about in Washington. It has direct, real-world consequences for your wallet. It's not just a government problem anymore. It's a household problem.
And that impact follows a really clear chain reaction. Step 1. The government borrows massive amounts of money, which pumps cash into the economy and fuels inflation. Step 2. To fight that inflation, the Fed jacks up interest rates. And what's the result? Step 3. The cost of your most important loans, the ones you actually have, skyrockets. Mortgage rates have jumped from around 2.8% to 7.8%, and credit card rates, they've soared to almost 22%. That's a huge hit.
Now, if that debt pressure wasn't enough, it's being amplified on the world stage by a super aggressive new trade policy. This is creating a global shockwave. The current administration has rolled out a sweeping set of tariffs that are, frankly, unprecedented. And we're not just talking about rivals like China, which is facing over 30%. We are talking about a massive 50% tariff on India, 39% on Switzerland, and even 35% on our closest neighbor and ally, Canada. This is effectively a broad-based global tax.
So, who pays for that tax? Well, you do. Economists are pretty clear on this. Tariffs are almost always passed on to consumers. And this translates directly into some staggering price hikes on everyday stuff. A 39% jump for leather goods, 37% for clothes. When you add it all up, these tariffs are estimated to cost the average American household about $2,400 extra per year.
Now, actions like these cause a powerful reaction, and what we're seeing is a reshaping of global alliances. This is the next domino to fall in the chain.
Just take that 50% tariff on India. You know, for decades, both parties in the U.S. worked to build a strategic partnership with India, the world's largest democracy, specifically to be a counterweight to China. And as Congressman Ro Khanna warns, this one policy is now actively pushing a key partner like India right toward America's biggest rivals.
This kind of pressure has basically accelerated the formation of a rival bloc. This alignment between Russia, India, and China, sometimes called the RIC axis, is getting stronger. They all share a common goal: create a real alternative to the US-led global order. And their main strategy for doing that? Actively trying to reduce the world's reliance on the US dollar by trading in their own currencies instead.
So, where does all this lead? All this uncertainty, this debt, this geopolitical tension? It leads to the final domino falling in the global markets.
The price of gold has absolutely exploded, surging past a record $3,500 an ounce. Now, this isn't just a market rally. This is a huge flashing signal of a massive global flight to safety.
And this spike isn't random. It's being driven by a perfect storm of factors. First, you've got geopolitical fear from the trade wars. Second, you have major fiscal anxiety over that $36 trillion debt. And third, you've got monetary tailwinds, because the market expects the Fed to eventually cut rates, which makes holding a non-yielding asset like gold way more attractive.
But the most powerful signal of all, the real stunner, is coming from the world's central banks. The so-called smart money. For the first time in modern history, their collective holdings of gold have actually surpassed their holdings of U.S. Treasury bonds. This is a monumental, historic shift.
So let's be really clear about what this means. This isn't just some market trend. It is a global vote of no confidence. The world's biggest financial managers are making a long-term, strategic pivot away from U.S. debt, and that signals a really deep concern about the future of the entire U.S. financial system.
So after watching all of these dominoes fall, from inflation here at home all the way to a global gold rush, you have to ask, what was the force that pushed that very first one?
And it turns out the ultimate source of all this instability, it isn't really economic at all. It's political. The core problem is what you might call extreme policy volatility, a situation where the fundamental rules of tax, of trade, of regulation can be completely torn up and rewritten every 4 years.
Think about it. This constant state of uncertainty makes long-term planning basically impossible for businesses, and it erodes the global trust that once made the U.S. the world's undisputed safe harbor. When predictability's gone, investors, businesses, and even entire countries start looking for shelters somewhere else.
And that leaves us with the final and maybe most provocative question. We've seen how one domino tips the next, from debt to tariffs to a new world order. But if the root cause of all this instability is the political system itself, what happens when the very foundation of economic stability, predictable governance, has cracked?